Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now, Constance Hunter. We're thrilled that she could join this morning. Constance, thank you. What changed yesterday? Just as simple. You're writing a single paragraph today to your clients. What changed?
Confirmation that inflation is still on its downward trajectory. That confidence was shaken about inflation when you got that data for the first 3 months of the year. Yesterday it confirmed finally OER is starting to soften. Rent prices are starting to soften. It was a print that showed we are moving in the right direction, and we are going to get rate cuts this year.
You and Julia Coronado fight like cats and dogs at MacroPolicy Perspectives, but what's the distinction of your debate when you and Dr. Coronado speak?
So what we are debating is which comes first, right? Does inflation allow the Fed to cut rates because they see that trajectory to 2% clearly and they cut in time? Or are they behind the curve? Are we seeing softening in the labor market that ends up overtaking the story, whereby they end up being behind the curve? And that has really significant impact for whether that rate cut continues to fuel a bull market or not, whether what we see on the underlying economy, the shape of the curve. Two very different outcomes if they're before or behind the curve.
Paul, I saw an article on New Jersey real estate, and I understand there's dynamics with mortgages, but the prices are up like double digit.
Yeah.
I mean, where's the slowdown?
Stuff's moving in Jersey, that's for sure. Whatever comes on the market. Constance, there's a lot of academics and market practitioners that Tom and I talk to that say the Fed's already behind. If you look at the real-time data, inflation's already done. They should be cutting now. What do you say to those folks?
I think they have a very good point. They have a very good point. The problem is, I was at Forecasters Club yesterday, and you would be surprised.
I wasn't invited.
There's a club for forecasters?
Yes.
Where do you guys meet?
Once again, you didn't invite me.
Anna Wong is the Bloomberg representative.
Oh, that's
I can't go.
Yeah.
Dr. Wong's there. They don't let trash like me in. Sure. Keep it up, Constance.
In any case, you would be surprised how many people thought that the Fed doesn't need to cut, that the economy is strong. And it is this K-shaped economy again, which makes it very hard to interpret, right? If you're in the top part of the K, you think, wow, everything's great. My stocks are up. I'm getting interest on my savings with no risk. The economy's doing really well. My house price is up. But if you're in that bottom part of the K, you're like, wow, my car insurance just went up, and I still need my car to drive to work, and I don't have the bandwidth to figure out how to push back on this or shop for a different insurance carrier that's going to give me the same coverage at a better rate, right?
Yep.
You're really under pressure if you're at the bottom half of that K. That's what we saw in the New York Fed data that came out with regard to creeping up with delinquencies on credit cards, creeping up with delinquencies on auto loans. Mortgages are still low.
Yep.
That's obviously a very good thing, but...
So we got, Walmart today put out some numbers which were a little bit better than expected, particularly on the top line. I always look at Walmart just as a neophyte as like a pretty good read on the consumer. But the consumer really is challenged, and it's that K-shaped recovery here. What happened? There's nothing really the Fed can do there, can it?
There is nothing the Fed can do there. I shouldn't say that.
But they're all...
But I shouldn't say that.
Okay.
Lower rates. So we have an inverted yield curve, which is obviously very problematic for banks, right? And banks, that's why we see such high spreads over 10 years on mortgages. Banks aren't as willing to lend. And so if we had a positive sloping yield curve, ergo the front part of the curve was lower, right? We would see more willingness to lend. We'd see easier monetary conditions for Main Street. What we see is easy monetary conditions for Wall Street. They're two different things.
Constance didn't say ergo until she started working with Julia Coronado. It's changed everything.
It has.
Okay, Atlanta GDP now is 4.2%. Real GDP, which we know is a fiction, and through the quarter will come down, it came down to 3.8. Where's that statistic going to migrate down to as we stagger to June 30th?
Yeah, we're looking at something around a 2.2, 2.4%,
So,
most
okay.
likely.
We call that okay.
That's that's if you think potential GDP is 1.8 or 2, that's a little better than okay, right? If you compound it 0.2% better than trend for months on end or quarters on end, that is a good thing.
Are all the gains with the stimulus and the financialization of our system, are all the gains going to the haves?
I don't know that that's the case. I think a lot of what we're seeing with the Inflation Reduction Act, the CHIPS Act, the infrastructure is jobs to middle income people. We're seeing good jobs going out into the economy that are important. So I wouldn't say it's all going to the haves.
How about on that labor market? Still below 4% unemployment rate. I mean, is the labor market as strong as it seems on that headline kind of number?
So this is where we, again, have some concerns.
Yep.
So we do web scraping of earnings calls, and we monitor for intention to hire and intention to fire. And so what we're seeing is less labor hoarding, right? Firms don't feel the need to labor hoard anymore. They've deployed.
Which I never heard of before the last few years, by the way.
Well, it wasn't a thing before the last
Okay.
few years. It was because of the pandemic where companies couldn't get workers, that once things softened up a little, they're like, well, I don't want to lose. It's hard to hire. It's expensive. It's time consuming,
Yep.
right? Better to reduce people's hours and keep them on the payroll for when you're going to need them later than to go ahead and fire them. So we had labor hoarding as a reaction to the pandemic.
Constance,
but that's
thank you.
ending.
Okay. Yep.
Constance, thank you. Constance Hunter with us. MacroPolicy Perspectives. We're going to do something now. Focus on oil, which we really know. Usually we're talking copper now. Copper's
Copper's been,
Copper's
big.
cooler than oil. Paul Sankey joins now, just absolutely definitive in this linkage of oil economics into actually oil stocks. We'll try to cover all this here right now. Paul, just to get to the OPEC meeting, are you going to attend? Sometimes you do.
This time it might go virtual, actually, Tom. So,
okay.
And I wasn't prepared to commit to going, even though it's the European Cup final soccer that night, June the 1st. It's also a Saturday.
Okay, it gets complex. What's the power of OPEC now? All of us have a stereotype of two oil crises in the 70s, or this or that or the other. What's the power of OPEC right now?
Well, we wrote a new theory about this, which most people intuitively know, which is what really matters is not the call on OPEC, which is how people have calculated the oil market balance for years. We don't think that matters anymore as much at all as you're implying. We look at the call on US unconventional, because that's really the truly marginal short cycle oil. Now, of course, on top of that, you have the Saudis' willingness, we should say. Everybody kind of has the ability to shut off production, but Saudis willing to shut off production in order to balance the market. And OPEC is really a construct for the Saudis to feel better about having to carry the market. So what they're trying to do is corral everyone else, even though in some cases, and the obvious example is Russia, what they say is more or less meaningless. Is that, I won't go further than that, but it's not reliable what they say, essentially, which must be very frustrating to the Saudis. But essentially, it is a Saudi construct in order for them to feel better about holding production off the market.
Paul, what is driving the oil price these days? Is it supply? Is it demand? Does one end of that equation kind of have a little bit more sway these days?
Well, Tom and I have been talking for 20 years. In fact, I'm surprised he didn't do his usual thing of hammering me for a terrible call that me and Adam Szymanski made about Russia. I think it was in the year like 2003.
That call was so bad. That call was so bad. Brezhnev aged. I'm sorry. Brezhnev aged when you made that call. Continue, Dr. Sankey.
No, I think the big thing, which is really remarkable to me in the context of that history, is that we're at all-time high oil market demand. So demand is at an all-time high. And if you'd asked me, do I think oil demand will be at 102 million barrels a day? 1,200 barrels a second in 2024? I would have thought you were crazy, but here we are. And so the demand side is truly remarkable. Now, of course, it's all about what happens at the margin, and demand is clearly weakening. So demand is good, but not growing strongly at a record high. What's additionally absolutely remarkable, and 20 years ago we would never have guessed this, was that you'd have too much supply. And so, as you know, there's arguably 4 million barrels a day of spare capacity in OPEC. And of course, we have the US as the dominant energy producer in the world. And, people still don't understand what an enormous deal that has been for everything that happens in the world, geopolitics, the dollar, you name it. The US performance here in oil and gas has been truly stunning. And the good news is that the companies have really improved themselves. They really are strong. I don't think I've seen Exxon in better shape in that 20-year period. They really are doing a remarkable job. And they're not alone. A company like Conoco, Chevron, really good stuff.
So in that context, Paul, how does the U.S. and those big producers you were just mentioning in the U.S., what's the interplay between them and OPEC in terms of shaping global oil supply?
Well, it's been controversial because obviously you saw that the FTC wouldn't allow Scott Sheffield on the board of Exxon.
Yep.
Because of concerns about that. And I think, frankly, they were simply naive. The major US CEOs at times, they didn't, we had covered refining for 20 years and I would host refining managements. They wouldn't be in the same room as each other because they didn't want to be, accused of anything by inappropriate in terms of managing the market. But of course, the E&P guys had never had any market power up to the unconventional revolution. And when we got to too much supply, they began to talk a lot to OPEC. And that at a headline level, it was actually quite innocent. But at a headline level, at an FTC level, it looks pretty bad, to be honest with you. It just doesn't look good. And so there has been some worries about that. But broadly speaking, the key issue is the behavior of the marginal US producer, who is showing capital discipline. And so US production growth has slowed and may even go into decline depending on where the oil price is. And we think that's because Saudi can't cut any more, essentially. We think that demand weakness will ultimately cause, prices that force US producers to produce less. And that's to me is the dynamic. Hence our call CUSP. The call on US unconventional is actually the important measure here, not the call on OPEC.
Is big oil in America, off your Exxon comments in the moonshot from the pandemic? And Sankey, I'm looking at Chevron right now. I got the same attribute pretty much. But is it a new big oil where you're looking at double-digit returns versus single-digit mediocrity?
Yeah, no, that's exactly right, Tom. They're in the double digits, and we always thought they could get there with capital discipline. Of course, you need oil above 70. We're at 80. So this is a good environment. The other thing that we're highlighting is that actually, believe it or not, there's lower oil volatility. I know it doesn't sound like it, but actually oil volatility is falling, and that's very good for the multiples of these stocks because, investors get very nervous about a highly volatile commodity and whether or not to buy the equities. What you'll notice is that we've held what we thought would be the range, which is essentially 70 WTI, 75 Brent to 85 WTI, 90 Brent. And we've held that range quite well. I'm very hopeful that we will continue to hold it. But of course, that's dependent on this OPEC meeting that we started with, because we do need Saudi to keep holding at least 1 million barrels a day off the market in order to keep it balanced. In the past, as you know, COVID particularly, we saw a market share war amongst OPEC. And that could be majorly volatile for oil, which would be volatile to the downside if we get into that. But nobody's expecting that right now. The consensus is that we'll get a rollover on June 1st, and they may just do the meeting virtually in order to achieve that. They often do it if they want to avoid the press. And I think that's what will happen. If it doesn't, I don't think they can cut more. The problem with the open meeting is there's only really downside here.
Paul Sweeney, XOI, off the pandemic gloom, up 320%, 41% per year. That's a Sankey move.
That is the Sankey move. Hey, Paul, if I'm a big global oil energy company, am I still out there looking for oil out in the ocean or out in the middle of nowhere, or am I just going to go buy a company?
You're looking because we incredibly, this is the other thing about the supply side, is it's not just about unlocking the Permian. What we've seen here, as you know, is Guyana has been a remarkable discovery. And we didn't think, the peak oil argument of the 2000s that Tom and I used to talk about has really just become completely discredited, and Guyana's huge. But then if you look at Namibia, Namibia looks bigger. And if you look at a company like Portugal's Galp or Total or Shell, they're finding another Guyana might even be bigger than Guyana offshore Namibia. So there's definitely a resurgence of offshore activity because the Permian is getting more marginal in terms of its economics. You've drilled the good stuff and you're having to work through the benches over the next 10, 15 years.
Paul, I got too many more questions. Let's do this again soon. Paul Sankey, of course, legendary on oil. Look for him for the OPEC meeting. What is it, June 1st, July 1st?
June 1st,
June 1st.
Yeah.
We got Lakshman Achuthan with us with ECRI. This is the most important interview of the day to rationalize a bull market. I'm sorry, Achuthan is more important than Diamond. Good morning. Good morning. Joe and the team over at JP Morgan, Lakshman here, with a really quick thing on our economic cycles. Do the economic cycles, Lakshman, that you look at, do they justify a third leg of a bull market?
Short term, sure. And so cyclical is looking at a couple of quarters. It's not looking out forever.
Yeah,
structurally, plenty of things to think about and to give you pause in the way things are going. But cyclically, I think we don't want to miss the forest for the trees. We were in the boonies, right? We had a really bad global industrial downturn.
We had a pandemic and all that.
But even after that, it still kept going. It was hitting Europe. It was hitting China. Remember, the beginning of 23, everybody thought China was going to come out. The global industrial upturn was going to be here. Yada, yada, yada. Never happened. Now, at the end of 2023, our global industrial stuff, really, the forward-looking stuff, started lifting nicely. And that's a nice backdrop for Europe. It's a nice backdrop for China. It's a nice backdrop for goods demand. And I hear all of the happy talk around inflation. Okay, the rent stuff is not right. The insurance stuff is not right. It's going to come down. Everybody presumes that goods inflation is no problem. And what we're seeing is if global industrial growth is turning up, and it is, that puts a bid on goods.
Paul, the chart here, we can't show it on radio. It doesn't. We can show it on YouTube, but it doesn't work on radio. Lakshman has a chart of the 5-year ahead GDP forecast. And the only thing moving up is India in the United States, Paul. Everything else is stable. Japan's resilient, But it's this U.S. exceptionalism.
That's where I wanted to go,
Wait a
Lakshman.
minute, Paul, he's breaking a rule.
I know,
he's coming in here with highlighted research notes.
They're very simple.
Can you explain to him?
Yeah, the lines are moving.
Paul, put that up in front of the camera for YouTube.
Yes,
we don't allow this, okay? Pink highlighters don't work. They're banned.
That works.
Continue.
So, about that U.S. exceptionalism, how unusual is that for the U.S. economy to generally be doing well, 3-4%, whatever it is, versus Europe, particularly Germany, and then China? How is that unusual to have that decoupling, if you will?
Well, certainly over the last couple decades it is. This is the breakdown in China is off the charts, and you can see that with the pink highlights. Germany doesn't look good. It's the sick man of Europe again. U.S. is up and India is up. Now, U.S. is up. I think part of it, we have to look at the excess spending. I mean, that's a lot of money we pushed out over the last couple of years. And that may be influencing some things. And certainly India, you know the story. They've got some population growth and they have an opportunity to do investment for other productivity-enhancing things. And so that's helping India. Everybody else is kind of in trouble on population growth. And the productivity growth is... a big question mark. It's not a given.
What do you tell your clients these days about China? I hear everything from uninvestable, which is kind of where I am, to you can't ignore it, you got to be there. How do you guys think about it?
Well, structurally, you've got a problem. Ideologically, I'm not so sure, right? You don't want someone making an edict and taking your money away. So those are real big risk factors. Cyclically, green light. Since the end of last year, cyclically, it's been a green light. You have this global industrial growth upturn. About 20% of the Chinese economy gears off of exports, which are gearing. Those are gearing now.
Right now, with us worldwide across this nation, Lakshman Achuthan, Economic Cycle Research Institute, ECRI. I got a brain freeze there, folks. It's been raining. We haven't seen the sun for 4 days. Give me a break. Coming up next, James Dimon, after Lakshman Achuthan with Francine Lacroix in Paris. I was showing a cherub today at work, the famed Ibbotson chart of Yale University, which, as Gartman would say, is from the lower left to the upper right. It is the exceptionalism of American capitalism. That chart goes back to Geoffrey Moore and the founding of ECRI.
Yeah.
How do you treat the immovable force, which is stocks up?
Look, there is an upward trend, which is undeniable in the U.S. economy over decades like that. And there's no great reason for that to change. On top of that, you have cycles. Right now, we're to the upside. We can easily flip and go to the downside in a couple of quarters. This is a very tactical framework that we're using, and we're overlaying that on the structural, say, wind at your back that you're describing. On this close cycle, the Paul's question, like, how is the U.S. bucking the trend up when everybody else is going down? Part of it, sure. The
is
innovation.
It debt? Do you say it's stimulus? The fear of debt,
I think it's an elephant in the room. Look, we haven't. There's, it's a tired phrase. Off the charts. We haven't seen this before. But the amount of debt growth is significant, and it's different. If you look at how the U.S. reacted to the pandemic and post-pandemic era, right? It was different from Europe and from China. China. They did their big investing after the financial crisis.
Just because of time here, we're waiting for Mr. Diamond. I want to tie Lakshman Achuthan, whose family's identified with New York City, into James Diamond, whose bank is identified with New York City. Do you believe in American exceptionalism?
Of course.
That's a theme that we've got right now.
No. I have no doubt about that. That hasn't wavered at all. But it doesn't mean I'm not concerned about debt growth. It doesn't mean I'm questioning, like, how real is some of the growth in light of the approaching $8 trillion of excess spending. Maybe you could argue the policy is that we should be investing in this and that, and that's fine, but let's recognize that. And so we described that last year as this tug of war between a big cyclical push downside to the downside and an offset from these non-cyclical items. And we've got some demographic stuff where jobs and health employment has been extremely strong, right? That's growing at 4%. That kept us out of recession.
We're putting does the Lakshman have makeup on?
I don't think so. It's just natural.
I don't need it.
We're putting makeup on. Francine's got out the L'Oreal. She's putting Guerlain or something on Jamie Dimon now. They're setting up the makeup. And they're in Paris here. I want to say this is the excellence of what we're doing at Bloomberg. We had David Solomon and Brian Moynihan with Jonathan Ferro here the other day as France does, what is it, Paul, like a capitalism week before the Olympics?
I think it's
like
come invest here. Come invest
in France. And people are.
I will.
I mean, ECRI's thinking of setting up a Paris office. What do you think? 6th arrondissement, or are you going to go across the river? What do you think?
Oh, I don't. Well, let's expand. Let's go across the river.
I just think it's booming. I've got some offspring over there. I'm very proud of them. I'm sorry, France is like a different environment right now.
Yeah, and right now, look, structurally there's a lot of issues that remain, and I don't want to underplay those. But cyclically, you've got a global industrial upturn, so you have some demand bid. And I think that's maybe the surprise with goods inflation down the line.
How does the real yield, what does your weekly indicator say about the real yield?
To the upside. It's still a little
a real yield signals a normal market, right?
Well, you can't. I mean, you'd like to have your cake and eat it too, but it doesn't always work out that way. If you have growth going up, it's not always that inflation just goes to the downside and you have this immaculate disinflation. It doesn't work that way. I would say I think we're banking on the global industrial upturn, and we're concerned about the knock-on effects for prices. And so that runs into the central bank narratives, which is, hey, we're cutting.
Lakshman Achuthan, thank you so much. It's Mateo now with our Bloomberg newspaper report. The newspapers are so strong, I got them front-loaded into tomorrow.
Oh.
What do we got, Lisa?
Well, you guys touched upon this, so I wanted to dig a little bit deeper. This is the Bloomberg story. Paramount holding talks with Amazon about an expanded partnership. So it's a lot to keep up with Paramount nowadays, you know?
Right.
But now they're saying that these talks, could amount to nothing, but it could include bundled sales of channels, advertising too. I didn't realize that Paramount Plus already one of the more popular choices on Amazon's channel store. So if you look on their channel store, they let customers subscribe to those things like Stars, Max, Discovery Plus. But Paramount Plus is on there. Paramount also a large supplier of TV programs to Amazon's Prime Video streaming service. So the relationship is there. It's just about where they're going to take it, I guess, from here. Is that basic?
I think that's it. I think that's it. Everybody's talking to everybody. Paramount also had some discussions with Comcast about a streaming joint venture. So it put it under the context of everybody's talking to everybody because we're trying to figure out how do I get profitability higher with my streaming business? How do I reduce churn? Maybe I need to bundle them with lots of other stuff.
Aren't they teen sweets? I mean, Netflix has X number of streaming people, and Paramount's like tiny.
No, Paramount's okay. Paramount's good. They're getting there. And, again, Nielsen just came out with some data earlier in the week to coincide with the upfronts and just showed that the share of streaming. And we saw that Disney was number one.
Right.
YouTube number 2.
Correct.
But the next 4 or 5 are all credible. They're all right there, and they're all growing. So, but
I
it's,
kind of like the bundle idea, though. I mean, it saves in the long run because then it's a better price for more of that.
The whole thing's a con job. I mean, I look at home.
Brian Roberts' father did this 50 years ago.
Screaming we don't have Max.
Oh man.
Kennel Fee is saying, why don't we have Paramount Plus? It's like they want to watch 101 Dalmatians. So what do we got next?
You can't win. This is from the Wall Street Journal. So more workers getting to the office earlier to impress the boss. They're starting at 5 a.m. 5 a.m.
That's
What time do you get in?
5 a.m.
Sometimes in at like 2 or 3 a.m.
I'm in bed before 4 o'clock. No, 4 o'clock I'm here, but I'm
Okay.
up at 2:30. So, But here's the thing. For regular folk who don't have to work a morning show, okay, they're shooting off emails before the sun comes up, right? There was a study that actually showed 21% users logging on between 5 a.m. and 9 a.m. this year. So that's up from 19% in 2021. So more people logging on before. But they say they impress the boss, right? They say they get a leg up on colleagues before that 9 a.m. meeting because they have more done. They have less distractions, so they get more done early.
And Paul, you'll appreciate this. I remember when I first joined Bloomberg, the demand for a 5 a.m. train from the north was so great they had to put on other new trains.
Oh, wow.
Because everybody started, and I had the clearest memory of going, wait, the day starts at 7:30, and then all of a sudden I'm in the office watching the sunrise at 6 a.m. And everything, Lisa, to the good point here, everything shifted to the morning, including, the act we do.
Well, it's a global business. You got to deal with Europe.
You got to deal with Europe,
more
exactly.
people have to deal with. But the question now you're starting your workday at 5 a.m. Is it from home or is it from the office? That's still good. And
it's from home.
I saw Bank of America yesterday was out with some research that showed occupancy of offices seems to have plateaued here at around 50%. They're now calling it, B of A's calling it, that's kind of the new normal.
Okay. Excuse me, if you start at 5 a.m., when does the day end?
Well, you can get your afternoons early. That's what they're saying. So, for example, like me, I'm in early. I get to go home and watch my kids' games, for sports, or get to, do other things. And then I have to go to sleep at 7:30. I have no life.
But next, what do you got?
That's it. Congestion pricing. That's what we're talking about. New York Times, another lawsuit. This is from a group, New Yorkers Against Congestion Pricing Tax. I think John Tucker might be behind this one. No, but their lawsuit, they're arguing that the tolling program could shift traffic and pollution to poor minority neighborhoods, things like Lower East Side, East Harlem, and the South Bronx, because people are going to start going the toll-free route, taking the FDR drive to avoid that. They're also saying small businesses are going to be affected because they're going to have less customers, higher costs for deliveries. It's going to cost them too.
Says who?
This is what this group is saying.
Do they have proof?
They are saying that the congestion pricing did not find the proof before doing this. So they're saying that they didn't do these certain studies that they should have done to prove that this is going to happen.
This is going to be tough.
I'm going to stay out of it. I'm not informed. I can't make an informed comment.
No, we'll let John Tucker. That's why you have John Tucker, the congestion reporter.
But I don't think anybody knows. I think it's a hell of an experience.
You can look to London, I guess, and probably learn some things
Stockholm.
That's where they have it,
Yep.
But I'm not sure the analog's there. We'll see.
Not here in the U.S.
Next, you got one more?
Last one. Beer sellers using this loophole. Okay. cannabis drinks market. So beers are being infused with cannabis, and this is a new thing. Yeah, because there's this loophole. So let me explain this quickly. Okay, so they were inadvertently legalized as part of a 2018 farm bill. You're saying, what am I talking about? Okay, so it allowed hemp to be grown to manufacture things like clothing, but drink makers, they use the loophole to distill hemp into this concentrate. Like, think of turning grapes into wine. So that's what they're doing. So alcohol distributors, they're lobbying to keep that loophole open because they want to keep doing this because they're saying alcohol sales are down. Right. So they're helping that this might help boost sales.
So weed-infused beer.
THC, yes. It's like a 0.3%.
Like is Budweiser doing this?
Oh, no.
No, it's there's a company, Cycling Frog, all these smaller distributors.
Lisa Mateo, thank you so much. The newspaper's already got one in the hopper for tomorrow as well. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.